Hello, everyone. Welcome to an Options Income Blueprint Weekly Income Report live on April 4th, 2022 at 11 a.m. Eastern with Michael Schulman. And my name is Emily Norris with Traders Reserve. We are recording this session. We'll be posting it to the member website. We'll also be sending it to you via email alert. If you have any questions throughout the session, feel free to pop those in the Q&A box. We'll get to those once we've wrapped up with Michael's presentation, and we meet tomorrow for live trading at 11 a.m. Eastern. That is Tuesday, April 5th. With that, I'll let you take it away, Michael.
Thank you, Emily. Thank you, everybody. Welcome to April in person. There we go. It's tomorrow, and one of the things I want to talk about at some length is how to trade an event. And because earnings are coming up, I think that's appropriate, for today's session. And it talks specifically about two of our stocks who are going to be leading off. The banks typically lead off earnings season in a couple of weeks. And I know that many of you are new. Many of you are new to listening as opposed to being new to the service. I'm going to take my time. We'll go through some things. But first, of course, I want to go over results. So we sold we sold put positions on two different core stocks, Marvel Technology and Pfizer, and we rolled that Marvel put as much for cash as to avoid assignment, and we rolled our General Motors and Bank of America positions. They're both calls. Many of you came in. If you're new, it's a put service. I didn't know you sold calls. In a blue moon, I'll put a brand new call position on, but typically call positions when we accept assignment, because I like the math of accepting shares and selling calls. And in fact, I'm even going to stop right now. I got an email from someone thinking of joining, and they were going, well, if I'm assigned, I can't afford to accept 100 shares per contract. Well, you have to, because these are cash secured puts. If you're going to sell a 5250 put, you have to have $5,250 of cash or margin in your account. I'm now going to be saying this once a month when we get together or in trading, because someone in the service managed to sell a naked put, which is never something anybody should ever do in a million years. And somehow it got through compliance and legal stuff at their brokerage house. So we had a pretty good week cash-wise, given that the market has been topsy-turvy. We're on goal. We were on goal with the 0.5%, which is, we do cash first. We worry about underlying capital value second. I know that's foreign to some of you. Again, emails from new members. My portfolio went down. First week, my portfolio went down, and I really felt like saying, so what? But that would be rude, and they've paid us money and paid me money. And the answer is, we're looking at cash returns per week, and we know from 10 years of trading history through 7 corrections and a crash that the approach of focusing on short-term cash and maybe looking at your portfolio relative to what we do here. I'm not talking about what you want to do with all your other equities. Look once a quarter. So the overall performance last week, the new trades, the potential return, or the return was there, and the roll trades, and we didn't sell any shares. So let's get back to, the surrounding environment that we're in. Q1 was the worst quarter in 2 years, not 20, not 50, no hysterics, please, 2 years. And of course, 2 years ago, what happened? There were the March lockdowns in 2020, and the market sold off. The NASDAQ, I think, was down as much as 38%. And we were back to profitability 5 weeks later. So stay the course. What's going on? There are a whole bunch of things going on. We have the Fed, Ukraine. Omicron's still with us, folks, and is inhibiting certain sectors. It's not inhibiting the opening up of the economy in general, but it's inhibiting certain parts of travel. It's putting a dent in restaurants. It's really making hiring in some sectors difficult, and it's still affecting supply chains in Asia. Shanghai is locked down. They said the industrial centers and the ports are open, but it does affect things. And now a slowing economy. I urge all of you, you can read it for free. Jamie Dimon, the head of JP Morgan Chase, and it's pretty much everybody's opinion, the single clearest, most important voice echoing what many on Wall Street feel. And in a nonpartisan environment, he would be Secretary of the Treasury. And I'm talking about partisans from both sides of both parties. It's nothing to do with what party. It's just, it doesn't appear that anyone from Wall Street can ever serve in the cabinet again, which is unfortunate. He said the supply chain issues plus inflation caused by Ukraine we could very well see a slowing economy. His analysts have already pulled down their GDP estimates for Europe and the GDP estimates for the United States. I've read other analysts that say the same exact thing. So what does this mean when we're looking at earnings? Q1 was tough on stocks, but it wasn't tough on the economy. And towards the end of March, we saw data that the economy was slowing. Why does that matter? Because what is going to happen when earnings come out is analysts are going to focus, is there a big miss or a big gain? Okay, fine, in first quarter, that surprises us. But the most important thing is, what's the forecast for the rest of the year? And how are you doing with supply chain issues? How are you travel? How are you doing with Omicron and in general, writ large? How are you doing with Ukraine? So those announcements are events. And many of you may have speculated in the past around earnings or an FDA drug approval or disapproval or a new product announcement from Apple. We don't do that beforehand. We may occasionally hold a share position where we own shares and sell calls. We may hold it into an event. Not often, but we do sometimes. But we trade events after the event. And earnings announcements and the ones that are coming up in the next 5 weeks, the majority of earnings announcements for big name companies are between now and about May 10th. If we can close a position profitably, of course, we're going to close and re-enter it after the announcement is over. If we have to take a paper loss or a net debit, which I've explained in a couple of different updates, and of course, it's up there in the training materials on the website, which I urge you to look at. We book that paper loss for a few days or a day or two or whatever it might be, and then we re-enter the position. You notice I'm not using the word trade. And again, I keep on referring to emails because that's my window onto how you're thinking. Is yes, we put trades on every week, 2, 3 new a week, 2 or 3, 4 rolls a week, whatever, generate lots of cash, but we do positions. So if you're looking at what happened on Friday and not considering what might happen the next week, you're not getting it. This is about positions that we manage for 2 or 3 weeks or longer than we prefer, like Bank of America, or core positions like Marvel, which we may manage for years. And the 2 announcements that I want to discuss are banking announcements. There's Bank of America on the 18th and Citigroup on the 14th. So to the point about net debits, let me repeat this. I answer lots of questions about it. A net debit is a paper loss, and it's not a loss. Your brokerage screen is going to flash red. You're going to want to know what my home address is so you can send me some, bad letters or something. No, it doesn't work that way. We do positions, not trades. And they enable us to take a look. And in the case of Citi and in the case of Bank of America, they need to take a look. Both are undervalued companies. Bank of America is it's the biggest and best regarded consumer bank in the United States. Outside of the super regional category, it's a mega bank and it owns Merrill Lynch. And purpose of disclosure, I've been a customer probably for 30 years. And they're undervalued because they have a very below average, and I'm going to get to that more specifics in a minute, they're below average dividend and stock buyback program. Citigroup is undervalued right now in particular because they were theoretically exposed too much to Russia. They got hit. It was nonsense. Well, not nonsense. It was not really material, but it hasn't recovered from that. So, but getting back to this, this is a very important tactic. One of the reasons we can be successful is ongoing familiarity with the name, ongoing familiarity with the stock, with the company, with its business. And I don't want to trade through earnings because I can't read what percentage of people in the stock on Wall Street that are traders and not investors are going to dump the shares in case they don't like the announcement. You see many announcements where companies beat on revenue, beat on profits, beat on operating margins, and maintain their forecast. This happened last week, or drop their forecast a little, and the stock sells off violently. And it's because a certain percentage, and it could be as little as 2 or 3% of the people trading shares or trading options or trading spreads or whatever, and these people are professionals, on Wall Street, they want to get out. They were too optimistic. So, and the other reasons to close, of course, besides that are announcements, and in banking sector, what would be germane would be a Fed meeting. So volatility in the premiums and the option chains increases earnings near. I'm sure you took a look right now. You can see that the premiums on a Monday morning right now for Citigroup and for Bank of America are higher than they were 2 weeks ago for the next strike. Volatility does remain elevated after the announcement comes out. It doesn't evaporate in a second, doesn't evaporate in a minute, doesn't evaporate in an hour, doesn't evaporate in a day. So sure, we give up the chance for a grand slam in the bottom of the ninth in the World Series, our optional double or triple, which is what speculators do. Go ahead and do it if you want to. But that's not the approach we take. And there's simply too much risk, too capital, and being stuck in a stock that you don't want to be stuck in if we go before the announcement. So let's take a look at the banking sector itself. They announce earlier than most companies. And the reason is pretty simple. They can compute how they're doing on an hourly basis. I mean, they do. And one of the things about banks that's changed a wee bit since the crash in 08, and since the Federal Reserve, quote unquote, has made things, they put what it's called, they call the Federal Reserve put, which they're taking off, meaning if the market goes down, the Fed will come in and add liquidity to the market. Banks prior to 2008 were almost always evaluated on price to book value. And yet book value, if you were a poet, an author, or a cynic, book value of banks is ephemeral because they're allowed to value their book hypothetically. They don't go out, they don't do real-time assessments of all the assets that they're holding. And since the crash, a lot of it more now is spreads between how much they pay to borrow versus how much they lend. It's about growth for the companies that have trading desks like Bank of America. It's about Merrill Lynch's performance, especially in fixed income securities trading. In Citigroup, a lot of it's about international presence and credit card operations, and so forth and so on. So the issue we're facing in these are if banks raise their forecasts. And a new wildcard that was introduced in terms of data in March, just in March, was loan and credit card write-offs. In the Income Masters program, we traded a Capital One spread and took a loss on it. It's the only positions that I will always tell people in advance I'm willing to take a loss, even if it's a little bit in the money, because spreads are speculative and your speculative capital, you should be able to absorb losses. But one of the reasons I wanted to close it and not roll it, which we do with almost all other spreads that are in the money, is because of the data concerning credit card debt. And Capital One has significant exposure. It's an important part of their business. And if they have to increase loan loss reserves, the stock's going to take a hit. So let's get specific. Bank of America, their earnings on the 18th. An important issue for them, because they're such a large retail bank, is what does loan demand look like? We know that mortgage refinancings have fallen through the floor because of increases in interest rates. Core loan demand will be very important. That's small business, big business, medium business, and people getting first-time mortgages as opposed to refinancing. And what do their margins look like, and how are they predicting their margins? Meaning, mortgage rates are typically determined when you go to a website, like you go to Bank Rate Mortgage Loan Calculator, you get advertisements, and you type in how much money you want to borrow, and they'll give you current rates. What banks are charging or mortgage brokers are charging. And it's pretty much set to the 10-year T-bill with a markup. So the question is what are loan demand and margins going to be, given that the Fed has promised to do certain things with interest rates? T-bills, 10-year Ts have caught up, but not completely. Merrill Lynch will be performance of the trading desk, specifically in fixed income securities, and their forecast. And Merrill Lynch should have had a really good quarter because it was pretty violent in the bond market in the first quarter, and the more violence in the bond market, the more you make when you're trading, if you're good at it. And Merrill Lynch actually is. And so loan demand and margins, there'll be a lot of questions from analysts about mortgage refinancings, which Bank of America is big on. So it's an if, and the forecast is an if. And all these ifs add up to, we will not be in an active trade of Bank of America on the 18th. We'll be out of a trade before the 18th, and we will get back in after the 18th, as I just suggested we would be doing. Citigroup, it took an undue hit, right? The hit that it took because it has some exposure to Russia was really ridiculous based on the math, and yet it's struggling to recover. So we rolled the call out this Friday. The company has announced its earnings next week, which means we're going to sit it out. We'll either allow ourselves to be called out, or we'll watch the call expire and sell the shares. And then we'll start the trade again after the 14th. And that would probably be, assuming we're called out or assuming we sell the shares, we'll be back to selling a put. And you count that against your net debit. What do I think of the company? I've been tempted for a while now. It's a core stock. I wanted a core banking stock in an era of rising interest rates. And I think when we break even on Citigroup, I think we might substitute Bank of America in, or even before that time. I think the issue with dividends and stock buybacks is increasingly important to investors looking for yield, and Wall Street knows that. And I think there's more of a chance if there's a dividend announcement or a stock buyback announcement that's bigger than Wall Street's expecting sometime in this calendar year, not necessarily in this announcement. It gives a little oomph behind Bank of America, which is already a very good bank. So going forward, in general, not just for these two stocks or the banking sector earnings, I hope to accelerate trading. We went down to one trade a week for a handful of weeks because of issues in the market. We're back up to two, and there may be weeks where we do three, and there may be weeks where if a stock moves and we sold a $50 put, the stock, let's say, was at 51, and now the stock's at 54 on a Thursday, we may roll it up, meaning we may buy back the 50 and sell the 52. I've been nervous about closes on Friday because people are nervous about going into the weekend to see what would happen in Ukraine. That nervousness on Friday afternoon seems to be behind us. We'll see. Excuse me. But I do want to accelerate the pace of trading and to accelerate the pace of closing early. And remember that the more volatility we have, it may make you uncomfortable if you're new to this. It means more premium and more trades, more opening faster, more openings and more closing faster. And I'll continue to close early when we hit our targets. And for those of you completely new, we have typically for over 10 years, this is not a portfolio approach. When I mention core stocks, we don't measure ourselves on the portfolio of trades we make. We measure ourselves on the average annualized rate of return for each individual trade. And that's been 20% a year, like 19.5 or 20.6 or something like that within a point 1.2 for 10 years. There's a consistency to our approach. And to get to that 20, your threshold, my threshold for looking at stocks and putting it in my trading bullpen is 25% a year. If you sell a put this time, Monday morning between 10 and 12, if you sell the next strike down, I mean stocks at 52, you could sell at 51.50. If it expires worthless, will we do a 0.5%? And that's a screen. And then when I set up trades, I close them. I don't want anything, with some exceptions, depending on the week in the market, but so there are exceptions, of a 32% target annualized return. And those numbers have worked for a decade, and I hope they will continue to do so. And on a specific level, when you're reading alerts, you may see opportunities in names we haven't traded before because the opportunities are just there. Earnings have come out. The market has reacted. For example, Delta Air, and I don't want to trade the airlines for more than a few days, but Delta Airlines trading is going to come out. I think they're on the 14th. And that might be a trade we do because we'll flush out people overly optimistic or overly pessimistic about Delta. And within a day or two of trading, we will get an understanding of how Wall Street is valuing the entire travel sector. I mentioned Delta for two reasons. It announces before the other three big airlines, Southwest, United, and American. And it also has the most transparent forecasting. It's very straight when it deals with Wall Street. No fuzziness whatsoever. And so there were a good window into what the sector would be doing. So if you see it, you may say, wait a minute, he hasn't wanted to trade travel stocks since the lockdowns. But in this case, with a short 2 or 3 or 4 day trade, after earnings come out, it may be appropriate. And because after earnings there are large premiums, more and more alerts will have good until canceled orders. And for those of you who knew, a good until canceled order is what it seems. You sell something for 50 cents and you put in an order that says, I will buy this back at 10 cents or whatever the number would be. And that's there good until canceled. And it's a great way to adhere to targets without you having to constantly monitor your account. So with that, excuse me, stuffy day in my office, we'll go to questions. I want to put a ring around or circle the wagons around the questions. If you're going to ask me what I'm going to do with the position that expires on Friday, I'm going to answer, I don't know. Now, some of these positions we're obviously going to roll because we're underwater on the overall position, like Pfizer or General Motors. So if it's a core stock in particular and we're in the money, we have a net debit or we have a cost basis above the current share price, I will be rolling them again because we're rolling to profitability over a number of weeks. But if it's a different kind of trade, I'm just going to tell you it's Monday. And we may close it early, we may watch it expire, or we may roll it. And so I'm not trying to cut off your questions. I just don't want to disappoint you and say, I'm not going to prognosticate what will happen 4.5 trading days from now. With that, let me turn it back to Emily.
All right, Michael. Chris says, people are talking about the yield curve inversion. I understand it's when the yield on short-term bonds is greater than the yield on long-term bonds, but what does this mean for us as options investors?
Nothing. It means there's been some very funny columns written about it. It used to be the perfect predictor of a recession 40 years ago. That's not exaggeration. And because what would happen is when short-term rates went above long-term, everybody said, well, the Fed is raising short-term rates because they want to head off inflation, specifically in housing, automobiles, and hard goods. And that's going to cause unemployment, which will cause a recession, and there are lower rates and the yield curve will change. But someone just wrote, yes, this is accurate. 5 out of the last 12 times the yield curve was inverted, there's been a recession. So it doesn't mean anything for us. Unless you have some ETF related to the bond market itself, which we don't trade. But it's more what some people think is an early warning indicator of a potential recession. And it's based on history as opposed to the way the world works now. I'm a skeptic, but it does affect trading in bonds and in currencies, actually. But independent of that, when I'm looking to see if there's a recession coming, I'm more concerned about employment data, and and macro events like government stimulus is ending and so forth and so on. So when I read Jamie Dimon's letter, one of the things I would add he didn't put it in the letter, is for lower middle class and middle class working people who drive to work or drive a lot. The Ukraine means a $1,500 to $2,000 a year tax in the form of elevated gasoline prices. And that's real. And that's mandatory spending. You may cut out a trip here and there, but that's necessary spending, which takes $1,500 to $2,000 out of discretionary spending, or, buying the 99-cent thing at the grocery store rather than the $1.99 thing at the grocery store. So I'm more into that kind of data in terms of concerns about the economy, because concerns about the economy translate to concerns about corporate profits, which turn into concerns about the market in general. So I'm not worried about the inverted yield curve. I am keeping a very close eye on data to see if we have a recession around the corner.
Okay, someone says, is your service for me if I have no intention of owning any of the stocks?
No. Sorry. I mean, let me put it this way. If you're not willing to own a share, you shouldn't sell a put. I'm sorry if I'm being heavy-handed or whatever, but if you sell a put, what's the point of selling a put if you're not willing to own the shares at the price, the strike price? And so I came back and answered that very quickly, because we're always going to be a situation where the math may say to own shares. Now I have people, and I'm going to do the flip side to you. I have people who never own shares. They will always roll their puts, but they have to have enough capital to do so. And sometimes when you have, let's say, a $50 strike price on a put, and the stock goes down to 40, there's no point in rolling the put. There's no cash. You're just buying time. Now, I might want to buy time for a week or two because it's a strange thing that made the stock fall so precipitously. But if it's going to take months or weeks to recover, and it wouldn't take months, let's say weeks, to that, it doesn't make any sense. But I have people, and we have members who've been members for 10 years, and I know them quite well, either from in person in Las Vegas and Florida, or from emails, or a combination of the two. They just will not take a recommendation I make to accept shares, and they just sell puts. Or if they're more sophisticated trader, they'll turn the position into a spread to free up capital. So I answered very quickly because I wanted everybody to know here that you shouldn't sell a put unless you're willing to own shares. And in this service, there will be recommendations to own shares. But there are people in this service, and there are people who've been in this service for many, many years who've never owned a share. So the decision at the end of the day is what you want to do. And you can send me an email about it, and I can walk you through how different people that I've come to know in the service manage positions trying to avoid owning shares.
Hey, Jim says, any comments on Elon Musk buying a 9% stake in Twitter? Does this make you more favorable on the stock?
No, I don't like Tesla as a stock, and I don't like Twitter as a stock. I really don't like Twitter. I don't like any stock that's personality driven. You know, Elon Musk could go off to space, and God forbid he doesn't come back, or he decides he wants to learn how to play guitar in Tibet or something. The stock's going to go down 40%. You know, there was a time when they make 300,000 cars or something, and they had a bigger market cap than General Motors. That's a cult stock. It doesn't mean that it's a very good company. It's a battery company that makes cars. It's not a car company that makes batteries. And if you understand that it's a battery company that makes cars, you can look at its future, and it's very, very bright. It really is. But Tesla's simply not a stock in this kind of a service. Now, Twitter, which we did trade for a while, we got out of it, and I think we took a loss because Jack Dorsey left. And Jack Dorsey leaving actually meant we stopped trading Square and Income Masters. So I want to explain to people about my view of fundamentals. Twitter has really, it's well known, and it's tiny in terms of its social media presence compared to Facebook, Instagram, TikTok, Google, whomever, whatever. And they've really struggled with a business model to monetize the use of Twitter and the frequency of use. They haven't figured it out. Well, Dorsey leaves. He was the president of both companies. The new CEO comes in and then goes on parental leave. I'm not making this up. Brand new CEO leaves after a few weeks to go on parental leave. Nothing wrong with parental leave. I take the job as CEO. Anyway, too much going on that's negative, even with Musk going into it. And Musk, you know, Twitter is paperclip money in terms of capital for Elon Musk. And I know he's highly annoyed with a lot of the powers that be that ignore him. So in the most primitive way, he's saying, I'm buying a company because I'm going to be able to do something so I'm not ignored anymore. And I'm not kidding. Now about Twitter itself, I don't understand their business model and how they're going to increase monetization of their membership. So as I said, I start with fundamentals. I don't like either one for what we do here. Twitter from a fundamental basis, in terms of the company's business model, Tesla's business model is understood, and I think it's a good one. I just think the stock is wildly overvalued if something ever happens to Elon Musk.
Okay, doesn't it make more sense to sell calls in a weakening market rather than puts and sell calls in a rising market?
Theoretically, yes. And if you could tell me exactly when a rising market is going to rise, or
I'm sorry,
a market,
sell puts in a rising market, but
yeah. Wait, the point is I'm market neutral in my approach, and I have to be. There's a lot of things that go on outside of what you see in alerts, and I know that half of you never take the training materials, which leads to a significant increase in my emails. But more importantly, it inhibits you from making correct trades or modifying trades that I put out there and you want to change. So I urge all of you to take a look at that. But even in the training materials, there are exogenous things that aren't discussed in the training materials or in alerts. And it's simple. I have a belief that you set your life goals. From your life goals, you have your goals for your portfolio. From your portfolio goals, you have the goals that you break down into what you need to do with specific trades. That's top down. The exogenous thing that I have going on is I start in the real world. I don't start with a chart. I don't start with a chain. I don't start with implied volatility. I don't start with beta. I don't start with alpha, although it's sort of an alpha-driven service. And the bottom line is I look at the fundamentals in the real world. It's the only service I know of, and that's not meant to criticize anybody else's service, where change and charts come last. And why do I do it? I do it because if you like the trend in the real world as it points to a great company and it points to a stock, it means you can trade that stock for an extended period of time generating cash independent of how the market is moving. So both things combine to set market neutrality is the only way for me to do things. Now, to your point, I do look at sectors, which is different than the market. So for example, last September, it became very obvious that money would rotate out of the financial sector into tech, specifically chips, and vice versa. And then it was to safe haven tech. Safe haven tech, Google's not a tech company, it's an advertising company, and Netflix is called a tech company, it's a media company. Okay, Facebook's a media company, but they use technology, they're lumped together as tech companies. Apple is a tech company. And money flowed between the two sectors. It was very predictable. So I do look, to your point, at how sectors are moving up or down. And that's much easier to discern, especially after an event like Ukraine, and to try to figure out what to avoid and what to do. But going back to your premise, the time to sell calls is anytime. The time to sell puts is anytime. The time where you're going to be able to make more money and close faster with puts is when the market is going up. And with calls, don't laugh, it's when the market is going up, because with calls, you have a double bang. You have the premium and you have the appreciation of the underlying stock. If you're selling calls, they're out of the money. So both of my approaches are bullish, but they're also market neutral. However, I'm repeating myself, I do take a look with exactly what you said at sectors, and I will avoid or go into a sector with more confidence, depending upon how that sector is moving, whether up or down.
All right, quick question from a newbie. Fred says, how important is it to place the trade at the time you recommend? Do the prices change quickly? If you can't get in until later in the day or the next day, should I hold off?
Yes, you should hold off. It's important that you trade as closely as possible to when the alert comes out. Exceptions would be, there are occasions like today's April 4th. I might, recommend an April 14th. It's a short month because it's a Thursday. First of all, April 1st was a Friday. So that would be normally the third Friday of the month that you would trade be April 15th. April 15th is Easter. So this Thursday is the shortest monthly expiration date in the calendar year that can happen. It can't happen any shorter than this. So in May, when you have expirations that'll probably be around the 20th, I may put out something 3 weeks in advance on a certain kind of stock, an opportunity, and that you could take your time. It might be a day, it might maybe two, but it's really advisable if you're concerned. And remember, we don't trade in such a way as it's frenetic. So typically the two new trades of the week are Tuesday when we do our live session, or if we're not doing a live session, it'll probably come out on the same day. I am increasing frequency in terms of closing, which you can handle with good until canceled orders or whatever. But the bottom line is, if you're going to do this aggressively and take advantage of the 120 trades or whatever we make, plus the rolls, so it's a lot of activity, get an app for your phone and get our text messages, which will tell you to go to the website, which you get to in 5 seconds, 10 seconds, whatever, and then you can see if you want to make the trade or not. But you should not do it the next day unless the prices are the same. If the prices
that's why
are
we use a go as low as price. So you should be able to look at the alert, see the current price of the stock, and we put on the trade, as well as our go as low as price. If the prices are close to that and you're comfortable with the rate of return, it's probably good. If the prices have moved significantly, either the premium has dropped too low, or even if it has skyrocketed, that changes the risk reward profile of the trade. So you may want to consider that.
She said it better than I did, but what she said is exactly what I was thinking. I sort of did a little circumlocution because I didn't want you to think you could do them a couple of days later. But what Emily said is correct, absolutely correct.
And generally too, when we put on a roll trade or put on a new position in an ongoing trade, if we think that it's okay for you to enter, we'll note that, but with the caveat that we are tracking and managing based on the ongoing position. But so just make sure you read alerts closely, and you should be able to discern whether or not it's a good idea to get in later or in the middle of a new trade or in the middle of an ongoing trade. Michael, I don't see any other questions at the moment.
Oh, I'll give people a 30-second shout out. Put your questions in. If something came to mind, of course, you should email me. Shockingly, I actually answer my emails within 24 hours. Usually it's rare that I don't get to them within 24 hours. I can't emphasize enough that one of the disconnects that I always have with people who've been in the service a long time or people who are brand new is, and in fact, I had an office hour last week. People who were in Florida were allowed to schedule office hours if I didn't answer their questions in Florida face to face. So they were in the virtual session in Florida. So we scheduled some follow up. And someone said, and this isn't meant to be a compliment or a criticism, he said, I don't know of any other service that does fundamentals and trading. You know, fundamentals are usually about a portfolio approach or equities, and trading is almost invariably about what is the chart, the beta, the implied volatility, one of the other Greek metrics, what is it telling you to do? And so the service is unique. And I personally think that that uniqueness is something that can be hard to explain to people coming going, I want to trade, or hard to explain to people going, wait a minute, I used to own stocks, I never did options, and now they're telling me to sell options. And yet, at the end of the day, this is about thinking like an investor. Apple's a great company, right? General Motors is a great company. And sure, General Motors is down because of supply chain issues. Apple's a little bit flat because of their market cap is so big. But I can do 0.5% to 1% a week selling options on fabulous companies. So you have to merge two ways of thinking. So if you have questions about any of that macro level stuff or the specific tactics and trades that you might see recommended, please send me an email. Last call for questions.
Michael, we have one from Edward saying, considering recent events in the world and the stock market, it seems the market neutral approach is open to big losses in a downturn. In a black swan event, do you believe a market neutral approach would still end up profitable?
If you were with me, first of all, this isn't a black swan, this is a correction. People like that term. A black swan is the United States government saying we're never going to lock them down, and then we wake up one morning and the United States government says we're locking down. That's a black swan. Market goes down 35%. And because it was a black swan, and because people could understand what was going on, one, the shock of we're not going to do this, we're not going to do this, we're doing it. And that led to illiquidity in the bond market. And the bond market in some areas froze up. The Fed had to deal with that in 2007, 8, 9. Fed came in, primed the pump, illiquidity ended. We were back to even, not to service the market, in 5 weeks. We had our best year ever that year. And I closed a grand total of 5 positions from over 600 trades across all my services. And I tell you, they were Delta, American, United, Boeing, and Disney. 5 travel exposed stocks. And because travel has not come back. Now the stocks have, but I don't really care except answering the emails. Why didn't we trade travel? We started to trade Disney again in the master's program. But my point is, if you look at what's going on in the real world, Ukraine is not an isolated event. Ukrainian-based inflation is not an isolated event, but it's something you trade around. And if you're worried about what happens over a 5 or 7 week period because of a sudden sell-off, I don't know how you put money into equities. I just don't. You either commit to equities and ride it out, or you become a day trader. And I know several people who become millionaires day trading. One friend of mine, and I did 10,000 index spreads a year, and he was brilliant, off the charts brilliant. That's not what we do. And we don't buy and hold and sit back and say Apple's going to be great in 5 years, which it will be. What we do is we make believe we're buying and holding, but we do it in a different way by selling puts or owning shares and selling calls. So the market neutral approach for the last 10 years has gotten us through 7 corrections and a crash, and we have always made money. And this isn't marketing hype. I'm not a marketing guy. It's just the way it is. I can't time the market. If I could time the market, and I'm not being funny, do you think, or if you could, would you be working? Anyone who could time the market properly for a period of 3 to 4 months could be a billionaire. It just doesn't work that way. And so the approach is what does work. Great companies in trends in the real world always succeed. Stocks may go down. We may have to take a loss occasionally because Wall Street has a different view of the stock that lasts too long for us to make money. But market neutral is the way to go. And that's my view. And my comments about day trading versus long-term buy and hold are my view. But that's also, this leads us to where we are right now, which is we have some positions underwater, but they're generating cash every week. And at the end of the year, I'm sure we'll be quite profitable.
Okay, that's it for questions.
Well, thank you all. And please, if your question comes to mind, send me an email. Thank you.
All right, thanks, Michael. Thanks, everyone, for joining us. We will be emailing you a recording of this video as well as posting it to the website. We meet tomorrow for live trading at 11 a.m. Eastern. Just check your email for the registration link for that. Thanks and have a good day trading.